So the first thing I'm going to talk about here is position sizing. All right. The sizing of your positions in the account. All right. So managing your money is linked to managing risk, and both are equally important because you have a certain amount of money to use, and you have to keep a tight control on your capital in order to make sure you don't lose it all and then find yourself unable to make more trades. So the best way to do it is to use a fairly simple concept known as position sizing. It's pretty simple. We always talk about that. You know, it's deciding how much you're going to use on every trade. And for those of you that have been here a while, I pretty much preach the same thing. Go equal on each trade, whether it's one contract, 2, 3, 5, 10, 20, it doesn't matter. Make the dollar amount the same, okay? And if you do that, you, in the end, should be okay, all right? Because this is what you have to do. And I mean, read it, read the screen. I'll let you guys read it for a second and then I'll go through it, all right? Because in order to do it effectively, you have to manage each trade in terms of a percentage. So, you know, if you have 1,000 and you do 10%, then the most you should be putting into each trade is $100. Whether it's an individual call or put or it's a spread, it doesn't matter. What goes into the trade should be $100, and that's it. If you have 2,000 and you decide that it's gonna be 10%, then the most should be $200. If you have a $5,000 account and you say I'm gonna put 10% into each trade, then it should be $500. Okay? So you guys all get that? Because if you don't understand and you have specific questions, that you should ask them now, because now is the time. Okay? So any questions on position sizing, just fire the questions in the chat and I will address them as we go through. Okay? So when you do that, it's a form of diversification. See, now you're doing trading and not investing, so it's different. But you're still diversifying because you're breaking your account up into many different trades. It's not that you're breaking it into sectors like if you were going to invest in a 401k or something like that. So it's not like you're doing that, all right? So you don't want to be, you know, relying on one specific outcome. So it's like, all right, I put too much money in PDD and now PDD got crushed and I lost a ton of money. Oops. Well, why did you do that? You know, like, really? Really? Like, did I say to do that? No. And then you thought you were too cute and that's what you did. And then you got your head handed to you. And it's not okay. Okay? It's not okay. This is why I say you have to do the same thing every single time, repeat it like a robot, and you'll be fine. Okay? Because read the last sentence, starting, even the most successful traders will make trades that turn out badly, and the key is to ensure that the bad ones don't affect you too badly. Doesn't that make sense to everybody? And everybody on here is guilty of it, including me, right? Is everyone guilty of that? Yep. I mean, that's what we're here for. So it's not like I'm going to sit here and yell at you, because I'm not going to yell at you. This is about learning. That's why I'm doing this. All right. And this is supposed to be interactive. So it's not just like Shark Talks the whole time and you guys just listen. It's that you guys chime in and ask questions and thoughts and concerns and things like that as well. That's what this one's about tonight. That's why I said it would be interactive. But I can't do it all by myself if you guys don't want to talk. I know it's Sunday night. I know everyone's probably tired. Some of you are probably still drunk from partying all day or yesterday. So, all right. So, I mean, that's what it is. It's position sizing. You have to abide by the same rules for yourself. And not everyone's going to do it the same way. Some people are going to put 5% in a trade. Some people are going to put 2% in a trade. Some people are going to put 3. Some people are going to put 10. Okay? The smaller the account, the harder it is in order to do that. But you then have to figure out how to manage it effectively. Like, you know, if you have $1,000, you have to figure out how to manage your account effectively. So, you know, if I'm in here with $1,000 account and I say, okay, what trades am I going to take? Am I going to only do trade of the week? Am I only going to do solid golds? Am I only going to do UOAs over 80? What am I going to do? Am I only going to do general call outs? Even if that means there's one a week? What am I going to do? And you have to stick to it no matter what. Okay. And stick to the position size that it should be. So if you say, okay, I have 1,000, I'm willing to put 10 or 15% into each trade. That's $100 to $150. That's what you do. If that means you get one, you get one. If that means you do a spread, you do a spread. If you turn a trade into a spread, that's fine. You're in it. Okay. And that's what you have to do. All right, guys. Any questions on that so far? All right. So if you have 50%, here's an example. This is actually a real life example. If you have 50% of your capital tied into one trade and it ends up going bad, and you lose, you probably lost a bunch of your account. That's a bad thing, as you well know. Now, if you only tend to do 5 to 10%, even if you have like 10 in a row, it shouldn't at that point wipe you out. Okay. It shouldn't, because you're going to have other trades that are on. So if you're doing 5% or 10%, then that trade shouldn't wipe you out. All right. Now, oops, sorry, did something here. So if you're confident that your trading plan will be successful in the long run, then you have to get through the bad times and still have enough capital to turn it around. You know, I'll give you an example. Okay. I'm going to give you a real life example. So I had an account. I'm going to give you a couple examples of different accounts. Okay. I had an account and I started with 25,000 and the account went through the roof. Like I hit awesome trades like right off the bat and it almost doubled. Like it happened too fast. Okay. And then I hit a bad snap and the account went straight down and there's nothing you can do. There's just nothing you can do. Okay. To the point where it was less than what we started with. But you know what? By keeping the risk the same and keeping the position sizes the same and not trying to outsmart the market or go heavy, like I see in the chat sometimes, people saying they're going heavy on a trade. By doing that, it gives you enough to get through that bad period and still give you that capital to turn the things around. Yeah, you know what? You lost money, but you're still there to trade another day. Does that make sense? You guys understand that? What that is? And if you position size properly for your, see, everyone's going to be different. That's the whole thing. Everybody's going to be different. All right. And position sizing will help you do that and get you through those rough patches. It's always going to happen. Okay. Like the last 6 weeks have been chop, chop, chop. Okay. It's been chop, chop, chop. It's not been easy. Okay. We're not going to go out there and day trade Tesla and Apple and Google and Amazon and Microsoft. We're not going to do that. Okay. Because the majority of you can't do it. So I'm not going to put you guys in the position and say, all right, here's the trade we're getting into. I'm not going to do it. I'm going to look for things that are going to work for the general population at FTP. All right. Trades like that and more aggressive trades are going to be the ones that I do with the life members because a majority of them can handle it. But I'll tell you, even some of the life members, they don't do this properly. And then they get their head handed to them on a couple of trades and they're like, what the hell? All right. So it's not just in the general shark population, it's the lifers too. So you know what? It happens. You just have to go through it and live another day. That's all. All right. Any questions on position sizing? Do you guys have any questions on that? Optimistic, you made a comment. So do you have a question? Other than you said to me, I don't know what I'm doing wrong. because that's not really a question, because I don't know what you're doing, so I can't tell you what you're doing wrong or right. So I'll just give you guys a second here. Okay, so that is a great question. That's a great question. The answer is almost always no. All right. Should we add positions when it's down? The answer is almost always no. The only time that I've done that, okay, is if I have a position that's down significantly, but I still have like 3 months to go, because time at that point is your friend. Okay. If you have time, well, it's 3 months isn't really long dated in the whole scheme of things, but for day traders and short-term swing traders, it is. So if you had something and it was down, then I would say yes, go ahead and do it. But it all depends, because what you have to look at is, first of all, what was the position that you started with in terms of what was the percentage of your account when you got in? If you maxed out what you should allocate to it, then the answer is going to be no, because if you say, all right, the most I'm going to put in is 10%, and you put in 10%, why now you're going to put 10 more percent, now you're at 20%. What happens if it doesn't come back? Okay, that's what you have to think about. Follow me? I mean, does it make sense to you, what I'm telling you? That's another good question. When you use a hedge, that is a great question. And it all depends on the dollar amount of your portfolio. Okay. The best hedge that I like to use is UVXY. Okay. Because it's a double. Okay. So the first thing you have to do is make sure that your account can do it, because not every account is allowed to trade those. All right. Those are called leveraged ETFs. So you have to make sure that, first of all, your account is allowed to do it. Some brokers make you ask for permission to do that. Some just let you do it right off the bat. It all depends on who your broker is. So you have to make sure that you're allowed to use that, okay? So if you're in calls, and let's say that that you see short-term volatility coming, right? Let's say the market's starting to get volatile, then you can load up on, if it's like early in the week, you can load up on front week at the monies or slightly out of the monies. Or if you want to buy some time, you go to the next week and you can go at the money or out of the money. Now, mind you, if you go UVXYs next week or the week after, they're going to be much more expensive, maybe even double the price, okay? Especially now, because we've had these gaps over the last 6 weeks. You'll gap up, you'll gap down. The market will go up 500, the market will go down 500. So, it really has to do with the percentage in your account that is in calls. All right. Because sometimes what will happen is the calls will go down. You turn around and get some UVXY calls, and you'll end up making more money with the UVXY calls than all the other things, all the other general calls in your account. And that there's nothing wrong with that. Because then when everything starts to come back and you sell the UVXYs, when you see the volatility going down, you've made a profit there, and now all your calls are coming back, so now you're making profit there. Follow? So you just sort of have to watch it, and it's different for everyone. Okay, because you have some traders on here, like Demon. Demon's going to do a lot of iron butterflies and iron condors and credit spreads, whereas a lot of you guys are not going to be able to do that because you just don't have the ability and or the capital and or the expertise to do it and manage it properly. Okay, that's why we have that spread channel, so that he can explain that stuff to you guys in the chat after he puts it up. That's the whole point of having that in there, so that he can explain to you the trade that he's doing in that channel. Okay, now I think he had a really good one this week. Snap, I think it was Snap. That was this week, right? He closed it around 30%, but he could have made, if he would have held it, I think he could have made somewhere in the neighborhood of 70%, 80% before he would have had to close it out. That was a great trade. I told him, I'm like, that was a fantastic trade that he did, because it just worked. Okay, because what you want to look for is you want to look for things that are overpriced at the money, because your at the money calls and puts are going to be the most expensive ones. They're always going to be overpriced. Always, always, always. Okay? Doesn't matter what name it is, it's always overpriced. Because here's the thing, and I know all of you know this, if you buy an at the money call and the stock goes down, how fast does that lose money, right? How fast does it go down? Quickly. Versus on the flip side, it doesn't go up as fast because it's already overpriced. Follow? So you always want to look at the deltas, especially when you're looking for movement. You want to look at the deltas. S17, does that answer your question? It was a very long-winded answer. Okay. That is an excellent question, because it all depends on the type of trade that you're in. Remember, we do a number of different types of trades here. So they all are going to have their own rules, as well as you're going to have your own trading rules, which you should abide by. Okay? So here's an example. Trade of the week was down, what, 45%? Right? I want to say, let's call it an average. Probably some were more and some were less on the calls before we flipped out of the calls and went to the puts. Okay? So 45%. Then if you flipped out and put the same dollar amount that you put into the call. So let's say you bought the call. Okay? And let's say you put, I'm just going to use numbers. Okay? Let's say you put $200 into the call and you lost 40, let's call it 50%. So you lost $1. All right? So now you got $1. Fine. Now you're going to flip out and go into the puts. Let's say you put 200 into the puts. You're already down 100 for the week, right? But you made 300%. How much did you make? 300% on a $2 put. How much did you make? What is that put worth when you sell it for 300% profit? I'm going to wait till someone puts the answer in. Yep. We'll take that 600 minus what you paid for it, which was 2. Right? Now you're 400. Minus the 100 that you lost. 300. Did you make a profit? Did you make a nice profit? I don't know if everyone did that with me and flipped to the puts like I called it. But yes, Mr. Optimistic, that's how you do it without selling against the position. That's how you do it. That's the easy way to do it. That's a technical trade, and that's what you do. Okay, when it's a technical trade, I'm all over it. I'm all over it all the time because you guys still need guidance on that trade. I'm trying to get you guys to not need the guidance on the trade. What I would like is I would like you guys to get so comfortable that I could put the trade up and not say a word the entire week, and you guys rock the trade. That's what I would like. But we're not there yet, and that's okay. But that's what I would like for all of you and the community as a whole. All right? So Tony said, is there a way when you're in calls and out of day trades that you could turn the call into a bearish position? So if you're saying that you bought a call and now you think it's going to go down, so you want to do that, yeah, you can turn it. You can sell a downside call if it lets you, like in a deeper in the money call. So let's say you bought so let's say Microsoft was $200. So you had the $200 call, but it starts to go down. You can sell the 190, but you're going to need the margin to do that because you've just sold. Now you've legged into, of course, well, it's riskier. And it's funny that you should say that because here you go. All right. This is how you manage the risk. What a good question. And look at that. I know you didn't even see my presentation tonight. So I'm going to get to it. So spreads are important and powerful tools in trading.